Welcome back to Bonnie's Life. Today, we are standing at the intersection of a $35 trillion global trade market, a fragile U.S Iran ceasefire, and a crypto market that is sitting on a powder keg of institutional money. If you have been watching the charts over the last 48 hours, you know that the volatility we are seeing is not just random noise. It is the direct result of massive macroeconomic shockwaves colliding with the digital asset space. We are going to break down exactly what is happening with global trade alliances, the one-year fallout from the Liberation Day tariffs, and how this geopolitical uncertainty is setting up a massive gamma squeeze in the crypto market. Whether you are a beginner trying to make sense of the macro landscape or an advanced trader looking for the next technical trigger, you need to pay close attention to the data we are about to uncover. Make sure you hit that like button, subscribe, and turn on notifications so you never miss these critical updates. Let us start by looking at the sheer scale of the global economy right now. According to the latest April 2026 data from UNCTAD, global trade grew by $2.5 trillion in 2025, reaching a record $35 trillion. Trade in goods drove most of this expansion, adding roughly $1.8 trillion to global growth. But beneath these record numbers, the fragility of the system is rising. We are exactly 1 year out from the implementation of the sweeping Liberation Day tariffs in April 2025. The Yale Budget Lab recently reported that the effective tariff rate in the United States now stands at 10.5%, which is the highest we have seen since 1943, excluding a brief spike last year. These tariffs were designed to reshape global trade, but the cost is being passed directly to the consumer. American households are now paying an estimated $2,510 more per year, with JP Morgan warning that consumers are absorbing up to 80% of the tariff costs. This protectionist shift has fundamentally altered global alliances. U.S China trade fell by roughly one quarter in 2025, a decline of about $170 billion. In response, we have seen the rise of connector economies like Vietnam, Cambodia, and Mexico, which are acting as intermediaries to keep global supply chains moving. As we look ahead to the highly anticipated meeting between President Trump and President Xi next month, the market is pricing in the reality that free trade as we once knew it is dead. This macroeconomic backdrop of rising costs and shifting alliances is the exact environment where alternative assets like Bitcoin historically thrive. But the macroeconomic data is only half the story. The immediate catalyst driving the markets right now is the geopolitical shockwave from the Middle East. Just hours before a critical deadline, a 2-week U.S Iran ceasefire was brokered, bringing a temporary halt to 6 weeks of intense conflict. The market reaction was instantaneous and violent. The Nikkei rebounded 5%, Brent crude oil plunged 16%, and S&P 500 futures surged. But we have to look at the underlying damage. The Ras Laffan LNG complex in Qatar had 17% of its export capacity knocked offline, and repairs are expected to take 3 to 5 years. The reopening of the Strait of Hormuz will take weeks, if not months, to clear shipping backlogs. This means the inflationary pressures from energy supply disruptions are not going away anytime soon. For traders, this geopolitical uncertainty has highlighted a critical shift in market mechanics, which FalconX recently dubbed the death of the weekend. When traditional markets close on Friday afternoon, geopolitical events do not stop. Traders are increasingly relying on the 24/7 liquidity of the crypto market to hedge their risk. This is why we saw Bitcoin surge past $72,000 on the ceasefire news. It is not just retail speculation, it is institutional capital using Bitcoin as a real-time barometer for global risk. And that brings us to the most important part of today's analysis, the institutional adoption of crypto. We are no longer in an era where Bitcoin is driven solely by retail sentiment. U.S spot Bitcoin ETFs have now accumulated over $53 billion in total inflows. 5 major asset managers, BlackRock, Fidelity, Grayscale, Bitwise, and Galaxy, now control nearly $100 billion in crypto ETFs. Just this week, we saw Morgan Stanley debut its $6 billion Bitcoin ETF on the NYSE Arca, sending a massive bullish signal to the market. BlackRock's IBIT led recent daily inflows with over $180 million, followed closely by Fidelity. This institutional wall of money is providing a structural floor for Bitcoin that we have never seen in previous cycles. At the same time, the regulatory landscape is shifting. The SEC has sent its new regulation crypto proposal to the White House, and the FDIC is moving forward with new rules for stablecoin issuers. The recent joint interpretive release from the SEC and CFTC classifying 16 crypto assets as digital commodities is providing the clarity that institutions need to deploy even more capital. When you combine this institutional backing with the historical data showing that Bitcoin tends to recover by 15% or more following geopolitical shocks, the setup becomes incredibly compelling. But to trade this market effectively over the next 24 to 48 hours, we have to look at the technical triggers. Right now, Bitcoin is testing critical resistance at $71,979. We have reclaimed key moving averages, but the momentum is fragile. The support zone between $65,000 and $69,000 is the line in the sand. If the ceasefire holds and ETF inflows continue, we are looking at a breakout toward $76,000. However, there is a massive wildcard in play, the mid-April options expiry. Glassnode data shows a negative gamma setup below $68,000. If the price drops into that zone, market makers will be forced to sell to hedge their positions, which could trigger a rapid cascade down toward $60,000. Conversely, if we hold above $72,000, those same market makers will have to buy, creating a gamma squeeze that could send prices parabolic. We also know that whales have accumulated nearly 850,000 Bitcoin between $60,000 and $70,000, creating a massive supply overhang if they decide to take profits. So, what is the strategy for the weekend? If you are a beginner, this is not the time to use high leverage. The volatility risk is extreme. Your best approach is dollar cost averaging and watching the ETF inflow data on Monday morning. If you are an advanced trader, you need to be watching the 0.236 Fibonacci level closely. You can play the gamma squeeze by positioning for a breakout above 72,000, but you must have tight stop losses below 68,000 to protect against the negative gamma cascade. The key triggers to watch are any breaking headlines regarding the ceasefire, the timeline for the Strait of Hormuz reopening, and the upcoming inflation data that will dictate the Federal Reserve's next move on interest rates. The global economy is undergoing a massive realignment, and the crypto market is at the epicenter of this shift. Stay rational, stick to your strategy, and do not let the noise distract you from the data. Thank you for tuning in to Born is Life. If you found this analysis valuable, please like the video, leave a comment with your thoughts on the market, and subscribe for more deep dives. I will see you in the next episode.